I think culture has been a huge issue that banks have faced in recent years. I think it really came to light around the practices that banks engaged in during the global financial crisis. Culture, in order for anything to change, has to start from the top. There is no such thing as culture permeating throughout an organization unless the leader of that organization sets the tone. And whether that's the overall leader, the leader of a business, that's where it all starts. I think a lot of the issues that we've seen as a firm when it comes to culture, especially around, let's say, talent, a lot of banks have looked at ways to reinvent their value proposition after the financial crisis. I mean, typically there were two reasons why you joined a bank. One was you got paid well. The other one is because there was a great prestige attached to working with that organization. I think both of these things have taken a huge knock in recent years. So what do banks then offer by way of being a great employer? So when it comes to talent, I think one of the issues with culture, especially with, let's say, junior bankers, was a traditional, I guess, feeling of burnout. And a lot of the banks implemented things such as a protected weekend or a protected Saturday. A lot of these things are related to policy, but we've engaged with a lot of people that worked in the banks that their feeling was these policies aren't necessarily affected. There's loopholes, there's ways to bypass them, and if a senior banker ultimately wants to override the protected weekend of a junior, it can be done. So where does that change in work-life balance happen? It doesn't happen from creating policies for the juniors. It comes from changing the culture of the way the seniors act, and that's where it starts, that's where it ends, in our view. I think there are a lot of regulations that went extremely far and knee-jerk in terms of what happened post-GFC. The one that comes to mind particularly for me that I saw was around compensation. You have bonus caps that came in, you had deferral periods. And ironically, banks have not created a situation where their cost base has become more nimble. The regulations have in fact just led to a ratcheting up of many base salaries such that fixed costs are now extremely sticky, very high, and the only way for banks to manage their overall cost base is via reducing headcount. It also creates issues in terms of recruiting talent. While, as a bank, you can defer compensation for your own employees, if you're looking to recruit some senior employees from other banks, often banks have to buy out their shares, and that can be an extremely costly process to build and recruit and replace. So overall, I think the industry has got themselves in a bit of a funny situation as a result of this regulation. I also feel, especially around this compensation issue, that it affects incentives. Because base salaries are so high, there are a lot of people that just don't feel the extra need to put in that bit more work to get out what they traditionally would, because that variable incentive component of their compensation just doesn't reflect or is not commensurate with what additional work they can provide in regard to their role. And I think bank CEOs have become openly critical about pay themselves. So it's creating an issue with regard to how people actually see the industry rewarding them in the long term. I think the lack of senior compliance roles is a function of many of these regulations being new. So even if you are a senior compliance person, it doesn't mean you have a very solid grasp on some of the regulations that are coming out. I think that does cause an issue in terms of the way business might feel comfort with the way the bank itself interprets particular compliance matters or regulations. But this is just a natural function of, the industry digesting these new regulations and becoming familiar with them. So this is an issue now, but I think in years to come, as the mid-level compliance professionals really do continue to become immersed in these particular issues and gain more experience. I mean, there is no shortage of demand for compliance professionals. So the will to leave to another sector of a bank, and compliance is the new M&A in our view. So it really is a hot area to stay in, and I think the value and premium that even a mid-level compliance professional commands is quite outstanding. So, and I don't see that trend changing anytime soon. But in due course, I don't see this as an issue. Those mid-level professionals will eventually become the seniors. It will just take a few years. It's a tricky one. I think overall that banks needed to be more regulated. There was no question of that. But the extent to which they've been regulated has actually caused some anomalies which I think are bad to not only the financial system, but those that the financial system and the firms themselves service. So if you look at something in the realm of, let's say, the global payment space, our firm has looked at this in quite a lot of detail. And one of the areas we're looking at is around correspondent banking relationships. And you're seeing basically a de-risking of correspondent banking relationships and a lot of firms cutting off jurisdictions or clients that they perceive to be too risky. There's a lot of forces that are driving this, but one of the key underlying ones is the cost of AML and CTF compliance. Now, the fines and penalties that tie to this as well are excruciatingly painful. You have a bank like BNP that was fined $9 billion US, HSBC almost $2 billion, and these are for sanctions violations. Now, as a result of this, as a result of cutting off your relationships to more risky jurisdictions, the global payment infrastructure is effectively being exposed to just being a bit more fragmented. You're also seeing banks like Deutsche Bank. I think they announced in their Strategy 2020 update at the end of last year that they were probably going to offboard up to 50% of their clients in corporate and investment banking and global markets because the KYC costs and onboarding costs and risk associated with having these smaller clients were commensurate, if not equal to some of the larger accounts. But the actual revenues generated for them are considerably less. So does that benefit the industry if all these smaller clients can't get access to financing, funding, hedging services? In my view, no. So I think there needs to be potentially a bit more of a balance about how far regulators have gone and a reassessment of what broader implications that's having for the client base that the banks actually need to service.